Good day, fellow investors. Verizon stock has been going down for the last 5 years, but at the same time the dividend has been going nothing but up. How come that the dividend is going up and the stock is going constantly down? That is what we are going to explain in this video. Calculate the intrinsic value of Verizon, and then you will see whether it fits your portfolio. So let's immediately start. Verizon down 36% over the last years. The decline has been covered by the dividend yield, but 5 years of flat where the market doubled isn't a stellar situation. The market cap is now 160 billion, and we're going to also put Verizon on the value investing quadrant to understand what is the risk and reward, calculate the intrinsic value, compare to others, and this was a stock that we often covered, and the key summary here is looks like a 7% dividend and 2.3% growth. If that continues, that's 9-10% return going forward. In a nutshell, Verizon 4 5G leader alongside with T-Mobile. They are expanding fiber frontier acquisition, but that again adds 20 billion on the debt. But we have to understand that Verizon did invest 200 billion over the last 10 years, 5G spectrum acquisition, everything that they are doing, fiber, and now even more with the recent acquisition. But due to that investments, there is also a huge pile of debt, which is always the anchor on Verizon stock. And there is not really much growth because it is a highly competitive environment, and T-Mobile has been managing to get more and more of Verizon's pie. Now we have the most recent acquisition, 20 billion frontier to get more fiber here. They say it's immediately accretive to EBITDA, but that is earnings before interest, taxes, depreciation and amortization, new investments, scaling, growth. So we'll have to see how will that affect Verizon going forward. Let's look a little bit at the earnings, and you can see here that the total revenue, we can say it flat as a pancake. That is what Verizon has been able to deliver. The wireless service revenue is growing but slowly. And if we are looking at cash flows from operations, actually those are down 2.3 billion if my math is not wrong. Fortunately for Verizon, capital expenditures are also down for 2 billion, so the free cash flow is there, let's say, in line and hasn't moved, which allows for a small growth in dividend, but the debt is also going higher and now in 150 billion. Okay, manageable, and that's always the case when it comes to Verizon, it's manageable. But we have to put this into an investing perspective, and what is the risk and reward for us investors. In my opinion, Verizon is a pure interest rate investment. What does that mean? Well, simply, interest rates is what everything else is compared of. If interest rates go up, the dividend yield Verizon needs to offer goes up. The cost of the debt, the 150 or now 70 billion, goes up to refinance, and therefore when interest rates go up, Verizon stock goes down. On the other hand, when interest rates go down, everything looks better for Verizon, less debt cost, better EBITDA, better profitability, a lower dividend yield, which means higher stock. And that is exactly what has happened. The dividend has been going nothing but up for the last 20 years. But you can see here the dividend yield also going up from 4.29 to 7%, and that is the reason also why the stock went down, because the expected dividend has been going up. Why does the market expect a higher dividend? Well, interest rates for a decade have been at practically zero, and at that time the market was happy with the Verizon dividend yield of 4%. Now interest rates are higher, people expect them to be at 3% going forward, and now the market expects a 7% dividend yield. So there is always a, let's say, 300 basis point premium yield on the, let's say, risk-free yield there from Verizon. That is how the thing is priced, And a big way on Verizon is the huge pile of debt. And if I look a little bit deeper in that debt, you can see there is a little bit of everything. There is still Verizon by states with relatively high interest rates, but that is small million amounts. Then we have the bigger amounts. Look at this. This is refinancing in 2025, and 0.85 is the interest rates. Now going forward, the interest cost there will be 5%. So that's 6 times higher interest payment on a billion from 1%. So that will weigh also off Verizon's future cash flows. Okay, they also have some great things like this. What is that? The 40-year bond at 3.7, 3% for 5 billion. That is free money in my opinion, given that inflation will be 3% going forward. But for now, the situation is this: Verizon stock is going down because interest rates are going up. If interest rates suddenly change and the Fed cut rates, then I would not be surprised to see the dividend yield going down again to 5%. All else equal, Verizon stock is also 30-40% up on that. So what is the main risk? The main risk is and always will be a dividend cut on lower than expected margins, slower growth than expected, and higher rates on debt. And if Verizon cannot manage like it does now and like it did for the last 10 years, if they cannot manage the interest rates, cost of debt, dividend payments, free cash flows, then a dividend cut will simply destroy the stock. Let's see more about that in the intrinsic value. So here we have our nice intrinsic value. You can download it in the link in the description below for free in my free value investing course. Now, if we click here on Verizon, make it a little bit bigger so that you can see it well. Here we go. Let's start, let me just close this, with a normal situation now. The dividend, I have already put it in here. The dividend is $2.6 per share. And now the key question is here, the growth rate. How fast will Verizon continue to grow the dividend going forward? There has been growth for the last 2 decades, as we have seen, and if they just keep on growing the dividend, all else equal, Verizon is fairly priced at the moment for a 10% return. Here I have the discount rate, 10% discount rate, that's a 10% expected return. And now I have here a terminal multiple on the dividend, 100 divided by 15, 6.8%, which is now the yield, and the intrinsic value is 38.35, close to the stock price. So fairly valued for a 10% return. But if Verizon manages to improve a little bit, or if interest rates go lower and now suddenly the required dividend yield is 5% somewhere in the future, then you immediately see Verizon going to 50 from that intrinsic value for a 10% return, which means that you would get a 12-13% return from Verizon at that situation. If we go to a bad case situation, if there is no growth going forward, but still the dividend remains, and the dividend yield goes to 8% on higher rates, then the present value sum is much higher. However, I have put here a probability. Now you can always play with these probabilities here and the normal case scenario or not, but okay, 60%, maybe a little bit too high for that. Let's put 50% on the normal case, 25% on the worst case, and 25% on higher rates. It doesn't change much, but just to make things more conservative. What would be the impact of a dividend cut? Let's say in 3 years, Verizon has to cut the dividend to manage the debt and lower it to, I don't know, 2. You immediately see how the present value goes down. If they are forced to cut it to 1.5, then you see the present value now would go to below 20. That is the key risk, which is still 50% down with a dividend cut going forward and no growth there. If then they start growing the dividend then going forward, then it would be okay, but still very, very low intrinsic value for a 10% return. You would need to buy it at 20. That would perhaps be a margin of safety buy. I'm going to delete the dividend cut here in the template just for future reference. So let's say fairly valued, all else equal here, and even if we look at the ratio, even better priced than many others, but there is this way debt ratio that I think is really hanging on Verizon and keeping it low. So if I put Verizon in my quadrant, I think there is a good situation for a 7% return. There is some risk, but those risks are in line with the market given its interest rates. So I would put it somewhere here, a good likely dividend. You might also be able to retire on Verizon, because if they keep on paying the dividend, if the stock goes down, you can simply reinvest, own more, own more. You're likely still going to use your internet, thank you for watching now, your phone, communications, this and that. So there's likely going to be a market. I don't think the telcos are going to destroy themselves over time. So there is, yes, a strong moat and no moat because of the highly competitive pricing wars that are going on and always will be. But there is always this way on the debt for me. I know it's necessary to be there to have everything working and the infrastructure, and thank you Verizon for 5G, for whatever. But it's also a way, and there will always be this, let's say, going left and right with Verizon on that. But in a diversified portfolio, it could be a very interesting, let's say, addition at the moment, especially US dividend diversified portfolios. If you enjoyed this, check what I do, subscribe, and I'll see you in the next video.